Okay, let's talk about two of the problems that are due for your next homework assignment. We'll go over exercise 11-3 and exercise 11-4, the B versions. Exercise 11-2 is pretty straightforward, so I don't think we need to talk about that. So in this case here, I've got two people, excuse me, Reed and Files, that started a partnership on January 1, year 1. The business acquired 70,000 cash from Reed and 140,000 from Files. During year 1, the partnership earned 75,000 in cash revenue, paid 39,000 in cash expenses, so they were profitable. Reed withdrew 2,000 from the business and Files withdrew 4,000. I've highlighted something that's key here. The net income was allocated to the capital accounts of the two partners in proportion to the amounts of their original investments in the business. So in their partnership agreement, that's how they agreed to split the profit. It could have been 50-50 or some other kind of an arrangement, but they agreed to allocate it based on their original investment. So first of all, the income statement. I'm going to have a proper header for the year that ended December 31st, year 1. So I've got revenue of 75,000, expenses of 39, net income of 36. Now, instead of doing a statement of stockholders' equity for partnerships, we do a statement of capital. So the statement of capital is going to start out at 0 because this is a brand new business. We're going to have investments of 210,000, and then we'll have net income of 36,000, which adds to their capital account. And then we'll have withdrawals of 6,000 for an ending balance of 240. Now the next thing we'll do is the balance sheet. For the balance sheet here, again, remember that's on a specific day, December 31st, year 1. So I have assets, I have cash of 240,000. Where did I get that number? I took a look at the cash that they gave to the business, that they contributed, 70 plus 140, that's 210. Plus we received 75,000 in cash revenues, and we had payments that went out of the business of 39,000, 2,000, and 4,000. So I can do that math, come up with 240. I have 0 liabilities, and then I have the partners' equity accounts, their capital accounts here, and I have to list both of those, and they have to add up to the 240 that I had on the statement of capital. So where did those two numbers come from? Well, in the case of Reed, he contributed $70,000, and the total amount of capital contributed is 70 plus 140, or 210, so he's going to get 72 tenths times 36,000, or 1/3 of 36,000, $12,000, minus 2. So 70 plus 12 minus 2 means he has an ending capital balance of 80,000. When I do the same work for Files, 140, now in case of Files, he's getting 142 tenths, or 2/3 of 36,000 minus 4. So 140 plus 24 minus 4 is an ending balance of 160. And again, those two numbers add up to 240, which they have to. Okay, that's problem 11-3. So 11-4 deals with corporations, and it deals with shares of stock. So Bronson Inc. has 300,000 shares authorized. For this problem, that's extraneous information because that's the number of shares that the board of directors has authorized management to issue. Doesn't mean they've issued them, but they can go up to that amount. So of that total, they've actually issued 175,000 shares, and 25,000 of those shares were repurchased as treasury stock, and they put them in a drawer in the office. So the company owns them. They're not in the hands of shareholders. It says they have 820,000 of assets, 250,000 of liabilities, and 40,000 of common stock, and 170 of retained earnings. So I can see they've got 570,000 of equity, stockholders' equity in this case. So the first thing, how many shares are outstanding? Outstanding means how many shares are in the hands of shareholders. Well, it would be the 175 that we issued minus the 25 we bought back. So there's 150,000 shares in the hands of shareholders. So the book value per share is going to be our equity of 570 divided by that number of shares, 150. So I get $3.80 per share. Now the problem says that the market value of the stock is $6 per share. So why is that higher than the book value per share? Well, the book value per share is what if we sold all of the assets for what we have them listed at, and paid off our liabilities and then cut checks to the owners based on their per share amount, that's what that would be. But the business, of course, might have unrecorded goodwill. We might have some assets that are worth more than what we show them listed out on the balance sheet. So there could be a variety of reasons that the actual market value of the company is greater than the book value of the company. So hopefully that was helpful. If you have any questions, please send me an email. Thank you.